Human nature never changes. History repeats itself all the time. Investing is when you buy something because the income or value it produces in the future justifies the current price. And speculating is when you buy something just because you think someone else will pay more for it later. Buzzwords create the illusion of expertise. If somebody cannot explain to you simply, they probably don't understand it either. Welcome to Fi Study Room, where we learn and achieve financial independence together. If you are ready to break free from the 9 to 5 and take control of your time, this is the right place. Quick note before we start. This episode is based on my personal experience and learning. It is not financial advice. So be sure to do your own research or talk to a pro if needed. Hey friends, welcome back to Fi Study Room, your corner for breaking down big finance ideas into chill, bite-sized episodes. Today, I'm walking you through A Random Walk Down Wall Street by Burton Malkiel. It's a classic that sold over 1.5 million copies. And if you've ever felt FOMO from a stock tip or a crypto post, you should really check out this book. Okay, so first and foremost, who is Burton Malkiel? He is a Princeton economist. He's also a professor of economics and former dean of Yale School of Management. He also served on the board of Vanguard. Yes, that Vanguard, the one that we buy index fund from. He's not just academic, he actually has been in the real investing world too. He has had professional roles in finance. For example, he was the CIO for Wells Fund. He was also advisor to Wall Street and policymakers. And this book was actually first published in 1973, and it is regularly updated to reflect modern investing trends. Like the one that I have right now, it actually includes crypto and meme stocks. And what is his key message to his audience? That is, most people, even the pros, cannot consistently beat the market. So why even try it? Okay, now coming back to the book. I've actually only finished half of the book. It's a thick book. And it's just so interesting to look at investment from a different perspective. First lesson. Human nature never changes. History repeats itself all the time. I'm going to share two stories. These two stories happened in different time, but it's just so similar. Story number one. Tulip Mania. Just imagine somebody spending the equivalent of your house on a flower. This actually happened in the Netherlands in the 1600s. At that time, tulips became a status symbol and prices just increased so much. At one point, a single flower sold for more than a skilled worker's annual salary, or even a house in Amsterdam. People were trading them like they were NFTs, and often without even taking delivery. So then, as quickly as it rose, the market just collapsed. And so many people went bankruptcy because of that. So what is the lesson? When people start buying something, just because the price is going up, it's most likely a bubble. Fast forward to a few years back, 2017. Crypto craziness. Bitcoin skyrocketed from under $1,000 to nearly 20K in 2017. It crashed and then hit 60,000 plus in 2021. Everybody was talking about this. Everybody had an opinion. There were real innovations in blockchain. I'm not denying that. Malkiel is also not denying that. But Malkiel's message is very clear. When the average investor starts treating an asset like a guaranteed ticket to wealth, we're deep into bubble territory. Malkiel also talked about whether Bitcoin is real money. And here's why. He says that Bitcoin is not money. There are 3 rules that, to be qualified as money, that assets need to follow. 3 functions. 1, medium of exchange. So people need to use them and accept them for goods and services. Second, it's a unit of account, right? Prices should be quoted in it consistently. 3, store of value. It must hold value over time. And according to Malkiel, Bitcoin fails all 3. It is too volatile to price anything in Bitcoin. Just imagine your coffee in Bitcoin and tomorrow it became like $10 or the day after that $100 per cup of coffee. And it is not widely accepted right now in day-to-day transactions. It also has poor store of value because its price just swings so much. It even swings more than meme stocks. So in his words, it is speculative asset. It is not a reliable currency. So while it may have potential as a digital gold or tech innovation, it's not what economists would consider as money. Another concept I really like, and I just couldn't help but just literally jot it down when I was reading the book. Malkiel was framing 2 types of mentalities, investing versus speculating. So what's the difference? Investing is when you buy something because the income or value it produces in the future justifies the current price. And speculating is when you buy something just because you think someone else will pay more for it later. Buying a stock because you like its cash flow or business model. Okay, that's investing. If you are buying it just because somebody else told you so, or just because it's trending on Reddit, that's speculation. So you need to know what you are actually doing. Are you investing or are you just speculating? So one thing I resonate so much with the book, jargon doesn't make you smarter. What's hard is simple. And here's where Malkiel has a little bit fun. He actually calls out Wall Street analysts for using big, fussy terms to sound smart. Something like, okay, we expect near-term volatility due to shifting macro headwinds, or this equity demonstrates low beta correlation with high alpha generation. What does that even mean? Maybe they don't even know that. Buzzwords create the illusion of expertise. Malkiel's advice: if somebody cannot explain to you simply, they probably don't understand it either. So before we jump into the specific analysis finance team often does, let's talk about 2 big picture ideas that Burton Malkiel uses to frame all of investing: the firm foundations theory and the castle in the air theory. These are like the 2 mindsets investors often operate from, even if they don't know it. So first, firm foundation theory. It's all about fundamentals. This is where you look at a stock and asset like a business. You look at its earnings, dividends, cash flow, and try to determine its value. If the market price is below that, you buy, hoping it will rise to match its true worth. Think about someone like Warren Buffett. On the other hand, castle in the air theory is driven by psychology. You don't even necessarily care about what the asset is worth. What you care about is what someone else will pay you for it later. This is actually where speculation thrives. You buy the stock, or maybe tulip flower, or crypto coin. Not because you believe in its value, but you believe that someone even more optimistic or maybe less informed will buy it from you at a higher price. Malkiel says a lot of market movements, especially bubbles, are explained by this castle in the air behavior. In fact, let's bring this home to where I live, the Bay Area. Everybody knows that the housing market is crazy. And it often feels like the perfect example of castle in the air. I'm always astonished at how much people pay for a house. And I don't know how to justify that. People buy a home at 3 times its logical value because they are betting someone else will buy it at 5 times. The logic isn't what's this house worth, but how crazy will the next buyer be. But remember, Malkiel is not saying that castle in the air thinking is always wrong. Well, sometimes it works until it doesn't. And that's when bubbles burst. That's why he actually pushes for index investing, because it doesn't rely on guessing the next streamer in line. So what are the kind of analysis Wall Street analyst uses in trying to beat the market, even though they mostly fail? There are 2 main methodologies, and then they tie to the theories that we just talked about. The first one, technical analysis. It actually maps to the castle in the air theory. So people look at charts, patterns, price trends. And the idea behind the scene is that history always repeats itself. If you find a pattern, maybe you can predict the future. Malkiel's take is like astrology for stocks. It's like more art than science. There is a second methodology, fundamental analysis, and it maps to our fundamental theory. This analyst deep dive into companies, look at earnings, leadership, growth prospects. It's actually more legit, but still not foolproof. Even hedge funds with armies of analysts often underperform index funds because of the efficient market hypothesis. They call it EMH, efficient market hypothesis. It says all known info is already priced into stock. So unless you know something that the public does not, aka insider trading, which is illegal, you are unlikely to have an edge. Because what you know, the public also knows, and they will act based on that. Most people trying to beat the market are just trading with other people trying to beat the market. So that's why a lot of the times fundamental analysis underperforms as well. After listening to all of this, what should we do, right? What should we do as smart investors? The advice is simple. I guess you can guess it from Malkiel being the board member of Vanguard. So his recommendation is that just buy the whole market through index funds. Don't chase trends, chase timing market. And trying to outsmart the market means additional stress, additional time, taxes, and usually lower returns. So what I learned from the book actually gave me peace of mind. It was actually really, really helpful to get deeper understanding of how Wall Street analysts evaluate different stocks and what kind of methodologies they use. Because I've heard so many jargons all the time, and to me, Wall Street is like a different world. And I've heard, friends around me talking about stocks, talking about, where they predicted will go, and then they use like all sort of buzzwords that I just don't understand. And this book actually gave me the knowledge that I really need. For anyone who's interested in knowing more, it's a really good read. So pick it up and then start reading it. And the book reinforced my belief that boring investing is actually good, it's beautiful. And it made me less reactive. For example, not panic selling or chasing shiny trends. If there is one takeaway, it's this. Markets are wild, people are emotional, and long-term investing is the superpower. Trying to get short-term moments, like trying to win at a casino with a spreadsheet, instead, just embrace the random walk, buy the whole market, and sleep better. So now, can you answer the question, what's in common for tulips, Bitcoin, and Bay Area houses? I guess all 3 of them, based on the stories that I've shared in the episode, they all fit into the castle in the air theory. If you like this episode, send it to a friend who's been asking if they should buy this stock or the other. And let me know, are you interested in the book? Should I finish talking about this in the next episode? Thanks for working with me. Catch you next time on Fine Study Room.